Thank you for tuning in to this week's edition of Top Minds in the Business by Oil and Gas 360. Today we are joined by Michael Carey. He is Chief Economist for Credit Agricole. Mr. Carey has routinely ranked among Bloomberg's top macroeconomic forecasters, and he is the second best forecaster of quarterly consuming spending figures in the last 2 years. He is scheduled to speak next week at EnerCom's the Oil Service Conference 13 on Wednesday, February 18th. So, Michael, thank you very much for joining us.
It's my pleasure.
So, you correctly projected the recent gain in factory output in December. What were the underlying factors that led to that prediction?
Well, when you're looking at industrial production, it's not all that difficult. You look at new hires in manufacturing. You have data on that from the payrolls. And then we look at the factory work week, how many hours we worked. And from those two, we can put together an idea of what manufacturing output is. And then the tricky part is trying to figure out the weather impact. And we saw a significant weather impact in the December figures with utility output dropping because of warmer than normal weather. And so while we maintained a decent increase in the manufacturing part, we also said that we thought the total industrial production would be a bit softer because of those swings in utility output.
Very good. What does the recent strong employment report from the Department of Labor indicate? Is this a short-term event or a continuation of any trend?
Well, I think it's a continuation of a trend, but it was a bit accentuated. If you look at the most recent 3 months, we've hired over 1 million people in this country. If you look at 2013, we added 2.29 million new jobs. That rose to 2.65 million in 2014. So I think it really is an improving trend. There's certainly less headwinds facing the economy than there were in the past, and now we have an additional tailwind coming from the decline in oil prices.
And that led me to my next question. Unfortunately, there have been some layoffs in the oil patch. Do you see this as a repeat of 1986? And if it is, how do you think those layoffs will impact U.S. employment or even the global markets?
Well, for U.S. employment, you have to sort of put it in perspective. When you look at oil and gas extraction and support activities, they employ only about 0.4% of total U.S. non-farm payrolls. Last year, they created about maybe 1.3% of the 3.1 million jobs we created. But the direct impact from the layoffs in the oil patch is still relatively small on the economy. You mentioned 1986, so if we go back to that period, really in percentage terms, the drop in oil prices is roughly similar, or same magnitude that we see currently. And at that time, we saw employment on a year-over-year basis, say by the end of 1986, we saw oil and gas extraction employment down about 16% from a year earlier. So if we were to see a similar percentage decline this time around, we might see something like an 85,000 worker decline in terms of the losses and job losses in the sector. Again, put it in perspective, that it compares with 3.1 million jobs that were created in 2014. Now, of course, that's just a direct impact. There are multiplier effects for service industries that relate to that. We know that would lead to a slightly larger decline, but I think in terms of the policy response from the Fed, for example, it's not likely, unless we see a really significant slowdown in employment growth, I don't think it's really going to change policy much.
Very good. And with the lower crude prices that you were mentioning, you've been very accurate as far as consumer spending is concerned. Consumer spending is about roughly 70% of total U.S. spending. What do you see consumer spending happening in 2015 if crude prices remain as low as they are right now?
Well, it's obviously a very significant positive for the consumer. When we look at the drop in gasoline prices as economists, we see it as analogous to a tax cut. So some of that windfall will be saved, but most of it will likely be spent. If you think about the average household, the American household, at current gasoline price levels, they would be saving nearly $750 this year compared to last year because of the lower gasoline prices. So we figure a lot of that is going to be spent. When we look at the various models that try and figure out the impact on overall growth, it could add as much as 0.7% to 1 full percentage point to growth over the next year and a half or 2 years, and most of that is coming from the consumer side. Now, you've got to keep in mind as well that there are some offsets. You mentioned the layoffs, obviously, in the oil and gas sector, but clearly we're also going to see a big drop in CapEx, in business investment spending in that sector, and that in itself could probably trim employment growth by, say, 0.2 percentage point.
And shifting overseas to Europe, the central bank seems to be pretty worried about the oil price slump, and they're committed to 1.1 trillion euros of asset purchases. Do you believe they're playing a good hand here, or do you think its member nations will be able to build their growth pattern?
Well, when we look at the Eurozone, first in terms of growth, we're looking at a situation that's weak, but it's not desperate. Okay, we're looking at growth this year somewhere in the range of 1 to 1.5%, and in 2016 maybe 1.5 to as high as 2% possible. Domestic demand there seems to be resilient. There's less fiscal restraint. There have been market reforms that have helped make, for example, their labor markets much more competitive, and that is all part of the process of healing that the Eurozone is going through. Right now, the top line numbers show a deflation. Okay, so the overall price level has declined from a year ago. The disinflation, or the outright deflation, depending on whether you look at the top line inflation number or the core, suggests that real disposable income is actually improved, and that helps consumers. So the response of Mr. Draghi and the ECB in terms of the new quantitative easing program that they're going to put will help in two ways. One, it's going to be associated with a further weakening of the euro. That will make European exports somewhat more price competitive in global markets, and it will also lead to higher import prices for Europeans. So that will move the inflation figures back into positive territory, we think, and it will also give a small boost to growth. The program will also probably help in terms of giving a boost to confidence, that people think, okay, the ECB is going to do whatever it takes to make sure that we don't go into some sort of deflationary environment like Japan. And so I think those two factors together are significant, and they're part of the whole healing process for the economy. The last part, again, is the banks, and of course, by the ECB buying these assets, they allow more of those funds to be lent out, either through the various programs that they have in place, basically encouraging banks to lend more to support growth. And this is particularly important for small and medium-sized enterprises that may not have adequate access to capital because the European banks were somewhat constrained for a while. So I think all in all, this is a pretty good move by the ECB, but again, it's going to take time before it comes to fruition in terms of stronger growth. The other thing to remember is that I mentioned the weakness in the currency, in the euro. Remember, since oil is priced in dollars, the decline in energy prices that we're experiencing here has not fully translated over to our European friends, because obviously the euro has declined 16% or so from last year, and so they haven't seen as big a decline in dollar-based oil prices as we have.
Very good. And with the move that they've just made, does that have any effect on Russia? Do you think their economy is as bad as everybody says it is, or are we just misreading the tea leaves?
Well, I don't think you're misreading the tea leaves. Russia seems to be in a pretty desperate situation right now, and it's basically the impact of the oil price drop, not so much the sanctions, in my view. I think the Russian economics minister, they were projecting something like a 3% drop in GDP this year. We think it's probably going to be at least 5% in 2015, and we see inflation rising to 12%. The growth and capital flow picture, I think, remain quite negative for Russia in 2015. And longer term, there are two things to think about. One, the Russian central bank decided to start easing rates to support the economy, but that means that the ruble is going to weaken even further, and it's worth about half what it was at the middle of last year. So I'm really can't be too optimistic there. The other sort of longer term issue, which I think is also a negative, is when we look at the geopolitical tensions with Ukraine and such, there was a lot of foreign direct investment going into Russia from Germany, from other countries in Europe, to take advantage of proximity and low labor costs and such. I think probably now you're going to see businesses in Central and Western Europe rethinking their longer-term plans that way, and that's going to be a longer-term negative for Russia, and I would lay that really at the step of the geopolitical tensions that have arisen.
Well, that's great. Mike, we really appreciate the time, and we really look forward to seeing you in San Francisco next week.
Great. I look forward to it as well.
Thanks, Mike.
Thank you very much. Bye-bye.